Now it's time for everybody's favorite segment, taxes. So what are taxes? Well, it's income or assets that are collected by the government. And you need to know that taxes are involuntary, so you can't really negotiate on them, and you go to jail when you don't pay them. So the overall advice within personal finance is, as far as taxes go, you should pay them. Now that I've convinced you that you should pay your taxes, there's a video below, super helpful. We're going to do a quick review on that, on the 4 different kinds of taxes. A tax on purchases, things you buy, tax on the things that you own, a tax on your, say, financial assets, and then a tax on the income or the money coming in the door. There are other ways that governments can raise revenue from different activities that we won't really focus on. Lottery tickets, the government makes money off of lottery tickets. Leasing, selling land, natural resources in places all over the world, that's how government makes money. Or also seizure of assets through, say, fines or civil asset forfeiture. Or if you live, unfortunately, in some country where the government just shows up and takes your stuff, that's another way the government can raise revenue. So the first category is a tax on purchases. That takes in, there's a variety of forms that can take. It could be a sales tax, which is common inside the United States, an excise tax, as we discussed previously with quote-unquote sin taxes, or value-added taxes, sometimes called VAT taxes. These are very popular outside the United States, especially Europe. But within the United States, as far as sales tax, they're generally applied by the state or the local governments in the U.S. on whatever purchases that you're making there. There's not a sales tax at the federal level by the U.S. It's likely unconstitutional according to current interpretations of law, at least from what I've read, although that is debatable. But it's generally applied at the state and local level. So when you buy an item, say groceries or a car, you're going to be taxed a certain percentage of that amount. And remember, excise taxes, there's kind of penalties for bad behaviors. They tend to penalize fun things. Okay, just kidding. But they tend to have an excise taxes on things like alcohol, cannabis, tobacco, sometimes firearms, candy, soda, stuff like that. Outside of the United States, we have VAT taxes, and it basically behaves very similarly to a sales tax, except the price that they tell you, like at the counter, like this costs $2, it actually costs $2, not $2 plus sales tax. So that's the primary difference between them. So the second category is a tax on property, or the physical things that you own. As you can see here, here's a graph on the right showing property taxes in different places around the United States. You can see that it varies a lot by the different region. So say you own a piece of property, let's say it's worth $100,000. The government taxes you on 2% of that per year, so you must pay $2,000 per year for the privilege of owning that property in that jurisdiction. Taxes on property can be not just land as far as property. It could also be, say, your car or something else that you own. And so you could be required to pay a certain percentage of the value of your car every single year. This is done in the United States, but it's actually more popular in other countries. The third category we'll go over just briefly, which is a tax on wealth. It's generally considered unconstitutional in the United States because of the Fifth Amendment, although legal scholars can debate about that. Taxes on wealth, your financial assets, they only exist in a few countries, and you would not be surprised that rich people tend not to live in them. And most countries that have had taxes on wealth in the past have eliminated them because they've found other more effective methods of taxation. The estate tax is not considered a wealth tax, since that's kind of what's inherited, passed on to heirs. The last thing to know about taxes on wealth is that they actually do exist in the United States and elsewhere because of inflation. And it's actually a kind of a tricky concept. So let's say that you have something that's worth $100 and that there's a 10% inflation that goes on, and that item is now worth $110. But in terms of inflation, adjusted for inflation, it's really worth the same amount. However, on paper, it looks like this went up by $10, that you had a gain of $10. If the capital gains tax is, say, 20%, you will be taxed $2 on that $10 gain. Now, did you really have a gain? Well, no, you didn't have a gain. However, as inflation goes up, your capital gains taxes go up, and it effectively becomes a tax on wealth. So inflation with capital gains taxes are indirectly a tax on wealth. So it's just something to keep in mind. All right, now we're to taxes on income. These income taxes are generally one of the primary revenue drivers for national governments throughout the world. And in the United States, we have an income tax that's generally withheld in each one of your paychecks. And at the very end, when you file your taxes with the IRS, you kind of correct whether the true amount that you actually owe. There's also the FICA tax, and that's withheld in each paycheck by your employer. You never see this. You don't have to file your taxes related to it. It's just removed from your paycheck. And finally, your investment earnings. Those are taxed as well. Those taxes on investment earnings can get really complicated, so we are not going to dive deep into those, but you need to know that A, they exist, and B, that it can be quite complicated, and that it's an area for more research as you evaluate your investment opportunities. Income taxes are progressive. In other words, the more money that you make, the larger percentage the government will end up taking of that. And the term that you need to know related to this is the marginal tax rate. So imagine that you make, say, $50,000 a year, and then instead of making $50,000, you make $50,001 per year. The amount that the government taxes of that extra dollar, we'll say 20 cents, your marginal tax rate would be 20%. Because if you make one more dollar, what percentage does the government take? Now, in the United States, and this is kind of mathematically, not like politically or opinion-based, the United States has very progressive income taxes. And the bottom 50% of earners pay close to no income tax, net of kind of the money that they receive. And we will be discussing FICA taxes later, which tend to be a little bit more regressive. Now, marginal tax rates are quite important. And remember, that's if you earn one more dollar, how much do you pay taxes on that extra dollar? People ask, why does this matter? Taxes are already so complicated. Why would you make it even more complicated introducing this concept of marginal tax rates? And the reason is that this is important for the decisions that you are making in your life. Now, imagine this scenario where you're married, you and your spouse are making, say, $80,000 a year, and you're considering starting a side gig where you would make, say, an extra $10,000 a year, work on the weekends doing something. Now, you're not going to be earning $10,000, but how much left is there going to be? And is that going to be worth your time? Say if the government is taking 30% of that, and you're left with $7,000, well, maybe it's not worth your time at $7,000. And so it's that thing to keep in mind on how to make these decisions at the margin. Now, with these income taxes, there are federal income taxes and state income taxes in most states, and sometimes even local income taxes. And so you need to take all of those into account when you're calculating your marginal tax rate to see how you should be spending your time that best aligns with your goals. To provide a quick example of what this looks like, I grabbed this from the Tax Foundation, on what just federal income taxes look like for different income amounts. And of course, there are a lot of deductions and credits that go on here, but I wanted to give you a flavor at least for what this looks like for different income categories, at least at a very general level. Now, as I said, income taxes vary a lot by state. And so you just need to know that, say, if you're in New York City, if, say, you were a high-income earner, you'd be paying a little over probably 50% of your income on taxes, whereas the same person in Florida would be paying, say, less than 40%, probably around 35%. So you need to be aware of kind of what your marginal tax rates are, and that's going to differ depending on where you live, how much you make, and what your current situation is. As far as FICA taxes are 7.65% of your wages. Some of that phases out after a cap of around $130,000. Some of that goes away. You should also know that your employer also matches and pays 7.65% of your wages as well, similar to what you pay. And so if you are self-employed, you need to end up paying both sides of that tax. Some people call that the self-employment penalty, but it's basically subjecting employees, whether they're self-employed or employed by someone else, to the same taxes. There are also, with FICA, you need to know that there are no deductions. There's no like marriage penalty. There are no deductions. There's no adjustments. That's what comes in and you pay it. There's nothing that you could do about that. So when you're going back to your marginal tax rate, if you take your wage, deduct out that FICA, add in that federal and state taxes, and that way you can figure out what that marginal tax rate is for your own decisions. The FICA tax rate, because some of it phases out, it's considered a regressive tax, as it more heavily taxes those at lower incomes before the phase out. But on net, the U.S. tax system is actually still quite progressive because a lot of the income tax rates ratchet up right around the same incomes as when this phase out occurs. So on net, you basically still have that progressive system, although not quite so progressive because of those FICA taxes. For those of you who have received a pay stub, this should look familiar, but just to walk through, on the left-hand side here, we have your gross wages, and on the right-hand side are these taxes that are withheld. So at the top, you have FICA Medicare, which in this case was $14.50, Social Security, which is $62, the federal income tax, which is just withheld from your paycheck. That's the amount where it could adjust on what you truly owe at the end of the year, which is why you file your taxes. And then in this scenario, there's a state tax for California and also the state disability insurance. So that's an example of seeing the money that's coming in the door and what the current total is of those deductions. And you take your gross pay minus your deductions, and you end up with your net pay. As far as taxes on investment income, it gets really complicated quite quickly. And here's one example. Let's say there's a company that you invest in. Well, the company pays a variety of different taxes, and then you pay taxes on what's left over, on what they pay you, the company. And then how much you pay depends on how long you invest and what you use to invest in that company and what investment vehicles you're using to invest in that company. So we'll touch on a little bit with this within assets. It can get quite complicated if you really dig down into the weeds, but we'll have some key takeaways on how to simplify both kind of your life and your taxes and some of the approaches that you can take then in section 6. Now, in most countries in the world, at the end of the year, you know how those income taxes were being withheld. Well, you need to see at the end of the year if the right amount was withheld, and if there was too much, you get some back as a refund, and if there's not enough, then you will pay more extra at the end of the year. In the United States, that needs to happen by April 15th, unless you file for an extension, and unless April 15th also falls on a weekend, then of course they will shift the date over. Some people fall into the trap of, I'm not going to file my taxes because I didn't really make much money. Well, sometimes you can get money back in forms of your refund. You could also perhaps get the earned income tax credit. There are reasons that you should be filing your taxes every single year. I would highly, highly encourage you to do that. If you do end up owing money at the time of filing, you're usually penalized, but it depends on how far off you are. If you're pretty close to only owe a little bit, then it's just going to depend on the situation. But usually how things work, like at your employment, is that the amount withheld is generally is erring on withholding extra rather than just the normal amount that you expect. So on average, most people receive a refund, but that's something that you need to monitor from year to year, and perhaps you need to adjust your withholdings. So this is done automatically, and you usually get a refund. And so sometimes people think, oh, let's celebrate, I got a refund from the government. Well, if you think about what a refund is, it's like you loaned the government money at 0% interest. So if you get a large refund, that means you miscalculated your income tax withholdings, and you could have invested that money and gotten interest on it instead of lending it to the government for free. Of course, the exception to that would be the earned income tax credit, which is beyond your normal refund. Now, generally, you wouldn't want to have extra withholdings. However, for some people, refunds can be a clever way to make yourself save money. So some people purposefully have too much withholding, and then when they get that check, say when they file their taxes in March, April, May of the next year, they're able to take that withholding check and then save all of that in one go because it's easier for them. Of course, that's for personal experience. Know thyself. But in general, if that's not the case for you, you should be shooting to have a very small refund. So no penalty, very small refund. You didn't lend the government an interest-free loan. Now, one last bit about paying taxes is that paying taxes, a lot of the cost is not just paying the taxes itself, but finding accountants, lawyers, etc. needed to navigate taxes. And thankfully, in this technological age of the 21st century, there are some solutions out there that many solutions now out there that make filing taxes a lot easier. And so it makes this burden not quite so rough as it could be. Now, admittedly, the United States tax code is pretty terrible. I mean, if you got a bunch of economists and accountants to design the optimal structure, not for amounts, but how it operates for the tax code, the U.S. tax code is not anywhere near that optimal level of how it should be done. However, there are other countries out there where the system of filing taxes and the complexity is actually much worse than the United States, so be grateful for what you have and for the software that you have to help you. Our final concept today is implicit marginal tax rates. So what are implicit marginal tax rates? It's when you take into account your change in taxes and your change in benefits. So let's walk through a scenario to illustrate this. So let's say you work and you make $15,000 a year, you pay no taxes and receive $10,000 in benefits. So the total amount of pay and benefits is $25,000. Now let's say you get a different job and you work and you make $18,000 a year, you still pay no taxes, and you receive $5,000 in benefits from the government. So in that scenario, you are receiving your income and your benefits of $23,000. So income plus benefits, it's $25,000 in one situation and $23,000 in the second situation. So the implicit marginal tax rate here, the formula for it would be your benefits lost plus your taxes paid divided by that income earned. So in this situation, the benefits lost was $5,000 plus the taxes paid. Well, that's zero in this scenario. How much income was earned extra? Well, that was $3,000. So you end up with an implicit marginal tax rate of 167%. That's greater than 100%. So in certain scenarios, you could make more money or take a job that pays more, but actually end up with less at the end of the day because of how benefits are cut as your income goes up. So this scenario is sometimes called a poverty trap, and that's where the combination of taxes and benefits generates a result where if you work harder or take a higher paying job, you end up with about the same amount of income and benefits than you did before, or even less. And the sign of a poverty trap is what we would call high implicit marginal tax rates, like the previous example. It can create this perverse incentive to not take another job or seek a slightly higher paying job. However, the thing to remember in a situation like this is that usually like one higher paying job will lead to another higher paying job, and you need to start marching up that ladder. We're going to walk through just a couple examples of poverty trap. There's a couple articles below that you should consider. So here's one in one of the articles from Slate. It says, it's a conversation, it's an interview. Have you considered re-entering the workforce? And the response is, I've thought about it, but if I get more income, then I'm going to end up worse off with less, unless I can make a certain amount, say $18 an hour. If it's for a job less than 18, I end up worse off, and so I'm not going to take the job that pays less than X amount. Now, the poverty trap is a real issue. I really enjoyed this quote from Jeffrey Frankel. He served in the Council of Economic Advisors during the Reagan and Clinton administrations. And when he had that opportunity to sit down, work out all the math, it's like, yes, the poverty trap really is there. And a popular kind of extreme example of this was posted quite a few years ago, but it illustrated the point where if there is a family that starts increasing their income, there are times when you're increasing your income, but it's quite flat in terms of your benefits and your income, and sometimes even negative. But at a certain point, you pull out of that after a certain income threshold, depending on the state you live in and also kind of your situation. And for every additional dollar, you end up keeping a substantial percentage of that. So what do you need to do to escape the poverty trap? Well, you need to move through that valley or that plateau and make it to the other side. So find jobs that enhance your skill sets and create paths to higher earnings so you can move past that trap and start earning income and seeing that positive difference in income. So even though something might make sense in the short term, if you stay in that valley of high implicit marginal tax rates of the poverty trap, there's that trap to just stay there and never leave.